a Sean Hadley original, so I admittedly stole this one. Having a positive mental attitude about private mortgage insurance. The general knowledge on PMI is going to be, most people think it stinks. Why does it exist? It's extra payment. It's all negative. This is to kind of take another look at it, see, historically why it's actually a great tool that we have. It's something awesome that otherwise would prevent most people from being able to get a conventional loan with less than 20% down. So. How it works. So it basically is providing a portion of default protection for the lender. So a way to think about when a lender is going to determine if they are or not going to provide a loan, they're making a risk assessment, right? Look at someone's credit profile and try and decide, well, here's my exposure in the event that they default. A person defaults on average, I don't have the numbers, but X amount or X percentage of time. So, I won't lend to anyone unless they have 20% down, just because, I don't want to expose myself to additional risk. So mortgage insurance comes in to help out there. This is kind of just an example, but let's say we have a $100,000 house. The person is going to put 5% down. So the loan to value LTV is 95,000. Mortgage insurer is going to look at that credit profile and basically say, well, we need 30% of coverage there so that we can reduce the lender's exposure. This little house down here is going to show you what that looks like. Basically, person's putting 5% down. The lender's exposure is only $66,500. That other 30% is the mortgage insurance. Now the buyer is paying that, but it's protecting the lender in an event of a default. Basically saying, well, okay, that reduces our risk to a point where we feel comfortable making this loan. So, go ahead and do it. Thumbs up. That's tough to explain to a buyer because they're like, exposure, LTV, what are you talking about? But general sense, it's basically just saying, hey, this third party is going to come in and make it so the lender isn't too nervous to do this loan. Mortgage insurance does not cover a number of things that a lot of people think it does. It's not life insurance. It's not like going to pay off the mortgage in the event of someone's death. It's not disability insurance, job loss insurance. It's not your homeowner's insurance. It's purely covering the lender's exposure. So even though the buyer is going to pay it, for 7 to 10 years, if they're putting as little as 5% down, 5 to 7 if they're putting, 10, 15 or more down, it's not necessarily a benefit the buyer's going to see down the road. It's purely upfront, giving them access to a loan they otherwise wouldn't be able to have. What does MI do for the borrower? A borrower can buy a home sooner with a lower down payment. So that was kind of what I was talking about before. Up until I have a history slide on here, and we'll see exactly what it is, but for the vast majority of history, you had to have 20, 30, 40% down for a bank to even consider you. MI came in the late 1800s as, the possibility of someone putting less than that much down and getting access to a loan. The huge help there was the creation of FHA loans by the government. Basically, they come up with their own MI configuration or calculation, and they opened it up to everyone with as little as 3.5%. And now that's how, having a home is relatively easy for most people that can save up a little bit and have fairly good credit. It's basically just providing someone with the ability to, only need to save up that 3 to 5% rather than 20, which there's a note in here, but it basically is reducing like 5 to 10 years of savings for the average person. You can get into a house 5 to 10 years earlier. That's amazing. Why is it critical? Promotes home ownership for first-time home buyers. That's a big one. 1 in every 2.5 GSE securitized purchase mortgages. That's a mouthful. What that means is GSE is a government-backed entity. That's Fannie Mae and Freddie Mac. For the rest of us out there that care, it's conventional. So 1 in every 2.5 conventional loans are using MI. That means 1 in every 2.5 are putting less than 20% down, using mortgage insurance to even get into a home. 1 in every 2.5 would either have to go FHA, or they would be stuck saving, into the future. Who knows whenever they'd get their house. So, I mean, if you think about it on broader numbers, it's kind of insane that without it, we would have way less first-time home buyers, way less buyers in the market altogether. MI provides credit enhancement needed for lower down payment buyers. That just kind of makes sense, basically helping out with the exposure to the lender will help out the buyer's qualification. Oh, there it is, 14 years to 6 years. So it was even worse than I thought. It takes quite a long time to save up that money. It's as long as 14 years. So there was an interesting period of time where after 2008 to 2010, mortgage insurance companies got just destroyed because of how bad the housing market was. A lot of them went, belly up, and the ones that survived were doing very little business. There was a period of time, I was not in the business, obviously, but Sean was, and he's talked to me about it, where you just couldn't get a conventional loan for less than 20%. He said it was terrible. Even if someone had 15% saved up, you would still have to push them to FHA. It's going to be an expensive loan. The MI doesn't fall off for at least 11 years. It's just, terrible situation. Thank goodness the ones that survived, grew, it came back, and eventually now it's something we use all the time. Here's a little history on it. So the first one was 1887, which sounds crazy. I can't even imagine, them coming up with quotes on like stone tablets. The housing boom after World War I was definitely where you saw way more of these home purchases. I mean, Cleveland, there's tons of them. Drive through like Mayfield Heights, and those little like 3-bedroom ranch houses. So post-war, they're really cool. You have FHA created, and they really kind of expand on that. Fannie Mae is created in 1938. So I could probably drone on and on about conventional lending. I actually will. I have a class in like 2 weeks on it. So I'll talk more about that. But Fannie Mae, basically, they were created to come in and purchase up mortgages from lenders in the market so that those lenders can go back out and provide more loans. It was like, hey, we're going to create this big government bank that's going to take a lot of these loans off the books of these other banks so that they can go back out there and we can kind of pump this housing market up for all these people coming back from war. Here, profitability and growth, competitive landscape. It went in the 1990s, they had a bit of a recession, not really a recession, maybe a correction. So you saw the reduction of the MI industry a little bit. It came back with full force in the 2000s. I don't think any of us were, watching the housing market too closely in 2004. But from what I've heard, it was insane. And, obviously that bubble burst in 2008, and we all have heard that story. That little section there kind of talks about what I just said. You went from having tons of MI companies to 3 basically, and they were barely operating as it was. You have all of the Dodd-Frank rules come out, and they basically have reshaped the mortgage lending world with all these new rules and guidelines to try and not, to try and prevent 2008 from happening again. In doing so, you also see mortgage companies, insurance companies coming back with these new rules and adjusting. One thing that I will say is mortgage insurance, I don't know if that was me. Someone have a question or something? I don't think so. So mortgage insurance companies have reached the point where I don't know if it's competition. I don't know if it's that they've just figured out their industry so well. It's cheaper than ever. I mean, you would be shocked. Someone with an 800 credit score might be able to put 5% down on a $200,000-$300,000 house. They're paying $20-$30 a month in mortgage insurance. They could even pay a one-time fee at closing. It's called upfront mortgage insurance. It could be as little as like $1,500. They pay it and it's gone. We have a couple of tools. I'll save it for the end, but we have a couple of ways of using mortgage insurance to unlock some benefits for buyers. Like I said, I'll come back to it, but here's where we get into the real boring stuff. I hope you brought a coffee. Calculating MI. So 2 scenarios here. Single premium is what I just described, where you pay one time at closing and never have to pay on mortgage insurance again. Monthly is the more common one. That's what most people are doing just because they don't want to spend any more money out of pocket at closing. Little breakdown here: $150,000 loan amount, down payment 5%, so LTV 95, loan to value. The MI company is going to look at the credit profile. They look at the credit score, the debt to income ratio, the loan to value. They're going to kind of determine, okay, well, here's how much exposure there is for the lender. Here's how much we are going to offer to cover that. So that comes up with the mortgage insurance rate here. To calculate that monthly payment, take the full loan amount by that rate, get $615 a month, divide by 12, and it's $51.25 per month. That's kind of how we come up with that number. If anyone's ever curious, most buyers are just like, cool, $50 a month, neat. They don't want to know what's behind the curtain, but that's how we come up with it.
Is it always a 0.41, or is that based on the credit score?
So that's actually determined by the mortgage insurance company. So what we do, and pretty much any loan officer is going to do, they have a whole portal of mortgage insurance companies, and we basically run a quote through all of them and take a look at who's the most competitive. Most of the time we're selecting the most competitive company. Sometimes they're all within a buck of each other and it doesn't matter, you could pick it blindly. But yeah, they kind of determine their own rates. I imagine there's a whole industry of underwriters coming up with those equations too. I've not talked to any of them before, but yeah. The other one is single premium. How do we come up with that? The rate's going to be higher because it's paid one time, and the lender still, the mortgage insurance company still is going to cover them that exposure. So something the borrower never sees again, but as far as the lender and the MI company go, that stays on their books. Borrower paid mortgage insurance and lender paid. We rarely see lender paid anymore, just because it is so inexpensive to go with the borrower paid side. Basically, borrower paid is exactly what you think it is. Either the single premium, pay it once at closing, or the pay it monthly. Anyone that's getting MI probably going that route. The lender paid side is, okay, the lender is going to make that actual one-time payment at closing. In exchange for that, you can take a higher interest rate, and that's basically how the lender's offsetting the cost. Now, the exact cost to the lender is not seen. It's not disclosed. It's, we negotiate on our end what that's going to be. We're basically offering the borrower, hey, if you take a little bit higher interest rate, we'll take on this burden of paying this, and then it'll be on us to go negotiate with the mortgage insurance company to figure out what our cost is going to be or what their exposure is going to be. Cancellation, this is for conventional cancellation, and then FHA cancellation, a little bit different. So the common knowledge is at 80% loan to value, 20% down, there is no MI. So with the same thinking, you would think it comes off automatically once you hit 80%. Not necessarily. It comes off at 78. I still have no idea why it's like this. The catch is, and this is what I tell all my buyers, if you ever get to 80%, you can call the servicing company and say, hey, can you get rid of it now? And they will. You don't have to wait for the extra 2% and however many months it takes you to get down to that number. Just making regular payments for both, you know, this is national, which is one of the MI companies, but any of them work the same way. For conventional versus FHA, at 78%, it's just going to come off on its own. If you're under 90% loan to value, so if you're putting 10% or less down, that's going to take about 7 to 10 years. You're putting more than 10% down, it's going to take only about 5 to 7 years. With FHA, if you're putting less than 10% down, you could pay on it for 30 years and you would have an MI payment every single time. If you put more than 10% down, it'll come off after 11 years, which makes FHA really, really expensive over the life of the loan. I would say this, if someone gets, you know, shoehorned more or less into only being able to do FHA, a few years down the road, once they have some equity built up in the property, they've paid down their principal a little bit, let's refinance you out of this into, you know, conventional, and you won't have to worry about, because honestly, we didn't get into the numbers on this, but FHA's mortgage insurance is expensive too. The rate is quite a bit higher than what you'll see, you know, on the conventional side. So. More on cancellation here. The other side, the other way to cancel your MI, I just had someone talk to me about this the other day. I think it was actually Karen's daughter who I spoke to. I also was working with Karen's sister, which is helping her whole family out. But if you have, let's say you've only been paying on it for 3 years. It's been a crazy last few years with equity, right? I mean, everyone's house is up $30,000, $40,000, $50,000. And you've just rushed all the way to the point where you're like, I definitely have 80% loan to value now because my house has gone up in value so much. You can call the servicer, which most of the time is going to be cross country if you're using us, and say, hey, I'll pay $500 for an appraisal. Will you appraise my house? And then whatever it comes in at, you know, can we reassess my current loan to value? And as long as it's past the 2-year mark, you can't do this within the first 2 years, but if you're past the 2-year mark, they will make an assessment. If the current loan is less than 80%, then they will call and cancel the mortgage insurance for you. A lot of people think that's a trick. I think it's just an unknown fact that, you know, I have people calling me all the time to refinance. They're already in conventional. They want to refinance into another conventional. Do you want to take money out? Why do you want to do? You want to lower the rate? What's the point? No, I just want to cancel MI. Just call them and pay $500. You know, don't have to pay $3,000 in refinance costs or whatever. This is more on what I just babbled on about. PMI factors. So whenever someone says, well, how are they coming up with this number? Why is my monthly mortgage insurance $120? My buddy said he only pays $50. This is it. Down payment amount, credit score, number of borrowers, if it's you know, primary residence or a second home, your property type. So if it's single family, 2, 3, or 4 unit, zip code even, if you're self-employed, debt ratio, low to moderate income designation, that actually helps. So if you have someone that can qualify for like a home ready or a home possible, have you guys heard of that program before? First time home buyer program through conventional lending, where they get reduced mortgage insurance, a reduced interest rate, and can put as little as 3% down. They just have to do a 2-hour class online and send us their certificate. Super awesome. If you have anyone that's like, I can't buy a house, like, I think you probably can. And then if you've had a bankruptcy or foreclosure on your credit report, those can linger around on a credit report for like 7 to 10 years. So even if someone's like in good standing, it still might be, you know, hanging out there. So the big thing about these PMI factors is these are like way more than we even look at for a credit profile. You know, interest rates don't even have this many distinctions of what will affect them. So, you know, MI is, they're honed in. They're looking at the full credit profile. So, oh, I remember. Before we do Q&A, tools for using PMI. There's two that I can think of right off the top of my head that I absolutely love. Let's say you have a borrower that's going to do that first-time home buyer program. It's called Home Ready, Home Possible. They have a 5% down payment, but they qualify for 3% down in this special program. We will push them over to the special program to do 3% down. They get the reduced interest rate, which is awesome. They also get reduced mortgage insurance rates. Well, that extra 2%, because they started with 5, we're going to do 3 for down. We'll take the extra 2, pay off the mortgage insurance up front at closing. So they're putting 3% down, coming up with the same amount of money they had been budgeting for the whole time, and they're never going to pay mortgage insurance for the life of the loan, which is a sweet way of kind of working the, you know, the system there, taking advantage of a couple of different angles. And, you know, when it takes kind of a special borrower, you have to have pretty good credit. You also can't make more than $62,000 a year household. That's in Cuyahoga County, changes per county. But if they fit that mold, wow, they're like, you're our hero. The other thing is, say you've got someone putting 20% down and the dreaded happens, their appraisal comes in short. Now what do we do? Well, what we can do is we can lower their down payment. So they're still going to be coming up with the same amount of money. They're putting less down. So that might affect their rate a little bit. Their monthly payment's going to go up a little bit for sure. There's mortgage insurance in there now. Oh man, I hate mortgage insurance. Well, this mortgage insurance is going to allow you to only pay an extra maybe 20 or 30 bucks a month if you have really good credit. And then all that extra money that we've just you know, opened up by putting less down, that's going to go cover your appraisal gap now. So now we've covered an appraisal gap. They're still qualified. They're still going to be able to move into this home, and they don't have to bring a dime extra out of pocket than what they had been budgeting the entire time. So no need to run to grandma and find a gift or anything. You can, you know, kind of play with the mortgage insurance possibility here and make it work. The other angle on that I love, especially when they have good credit, is the one-time mortgage insurance, the single premium. Because if someone's got the budget to pay $30,000 over asking, and they just don't want to have to, if they don't, you know, if they don't need to, they look at that, you know, $1,500 to cancel PMI forever, and they go, oh, yeah, just do it, and they won't think of it ever again. So I don't think anyone got on Zoom, but do you guys have questions?
No, I think it was helpful because that was the scenario that you were just talking about, was negatively.
Yes. Mm-hmm. Right.
But they were totally against it.
Yeah. Some people, mortgage insurance has kind of an icky, you know, perception. Some people are just like line in the sand, I'm not doing it. Other people, if you give me a chance to break down the numbers, put a scenario together in an email, and they say, I'm only paying 20 extra bucks a month and it's going to fall off in less than 5 years. Yeah, go for it. So.
Yeah, I've heard some of our clients talk about having to take a mortgage class or some 2-hour class. I have to do it by this date.
Yeah.
So I've never known really what that was. But it sounds like that.
It's
kind of home buyer thing.
Yeah, so if you Google Home Ready, Home Possible, there's going to be a bunch of info on there about it. There's several classes. They can take any class that's approved by HUD. I almost think that they should maybe take it in the beginning, like before you guys even start looking at houses, because I've had so many people, they take it just to be able to qualify for this program, and it like makes them do budgeting, and they have to like take little quizzes, and they're like, why didn't I do this when I started? I wouldn't have been shopping at this price point that my realtor had to convince me not to go for. I mean, it's definitely a useful class. And yeah, most of the time, if they're saying I have to take some class and send them a certificate, that's why. Because if we don't, all of a sudden your rate goes up and your mortgage insurance goes up, and we're scrambling. But,
So
cool.
the 20% down, I know a lot of people, first time buyers, that would be cash. But when it's like second purchase, most of that can come through the proceeds. Right?
Yeah.
So you mainly see PMI for like first time buyers.
Yeah.
Unless they're like.
Right. Yeah, especially right now, because anyone that's owned a home for the last 5 years and is selling it has so much equity they don't know what to do with. Most of the time in those scenarios, yeah, I'm not even asking for bank statements. If we know they're going to close, I'm just putting proceeds from the sale and we'll work it out between the two title companies down the road. On the other hand, you do have people that are maybe trying to qualify with the current without having to sell. Yeah. So another scenario here, let's say somebody has a house to sell, maybe it needs a little work. They know they're going to get a ton of equity in it. They know it's going to be a windfall of cash once it happens, but they're not messing with it now. They want to go buy their new house first. They will be able to, and most of the time I push them for 20% down, so this is a little off topic, but they would be able to qualify at the minimum, let's say 5% down. And, we close on that house without having to sell the first. Now they're moved in, they're happy, they got the bathroom remodeled, time to sell the house. They can sell that house, get the windfall of cash, and instead of needing to refinance their current home, they can recast it. Basically, call up the servicing company, give them $350 and say, all right, I want to make $100,000 payment on my principal. It's not going to change their interest rate. It's not going to cancel MI right away, but they will restructure the whole payment. And then once that 2-year mark is up, they can call them back up and say, hey, let's do an appraisal. I know I have the equity because I put an extra $100,000 down. They'll do the appraisal and then they'll cancel the MI. So I just did one for Irene Molnar, buyers over in Euclid, that exact thing. They're like, my husband doesn't want to do the work we need to sell this house, but we fell in love with this house over here in Euclid. And yeah, we just did it. Now that one was 20% down, so there was no MI, the rate was pretty good. So really all they're going to be doing is highly reducing their monthly payment once they make a big old payment onto their principal. But that's another kind of thing that every lender has. Most lenders, I would assume, we definitely have it, that people don't know about. They think they have to refinance, but you don't. And I know there are some people who are nervous about getting into the market because they're like, well, I have this house that it's becoming a lingering thing. I'm gonna have to sell this house. I don't even want to look at a new house until I figure out what I'm gonna do with this one. I can tell you actually don't need to. So, that's kind of a selling point for some people, is to know, hey, I can double back in 3 or 4 months once I'm moved, and then we can take care of the old house. So that's a recast. The bridge loan, we have it. Usually what I say is, if you can qualify for the bridge loan, you're probably going to be an excellent candidate for the recast. The recast costs $350. The bridge loan is 2 full closings, 2 sets of closing costs. Because you're going to close on a loan to come up with the down payment against the equity in your current property. Then you're going to close the second time on the house, the actual regular closing cost you would run into anyway. So that first loan to come up with the money you need for a down payment, it might be 1 or 1.5%, plus there's some processing fees and stuff in there. If you have the room, let's just go with the recast. $350. It's not too bad. I mean, it does require you after the fact to call and start the process with the servicing company, rather than doing all of the loan processing up front. But if you're okay with saving thousands of dollars, it might be worth it for you. Yeah. Yeah, so I throw that around a ton, and feel free, you know, if you have anybody that's on the fence and wants to know more about that or know if they qualify, happy to help. Cool.
Thank you.
Yeah, thanks,
Great.
guys.
Always good to have helpful information.
And this one's a fun one because do you have a positive mental attitude about private mortgage insurance now?
So what's your conventional cost gonna be?
I'm going to dig in a little bit more about the history of conventional lending. You know, I like to give people an idea of like what lenders actually see. I think a lot of lenders, for whatever reason, have never understood it. They want to be like, yeah, all this stuff over here, don't worry about it. In reality, you know, how do we come up with interest rates? Well, you know, we don't just make up, hey, today's rate is this. Like there's so many factors going on, and a lot of it has to do with these huge, you know, government-backed Fannie Mae, Freddie Mac companies that are more or less buying 90 to 95% of the loans that exist out in the market. They're saying, hey, here's the price we're buying at, you know, do with that what you will. And then the companies out there trying to buy those allocations are competing with each other. And that's how you eventually trickles down to, okay, this is what, you know, the Smiths are going to pay on their new loan after the, you know, the big companies all duke it out up top. So to give people an idea, and you know, hopefully it's not overly boring, this is what the conventional world looks like. These are the guidelines. Here's why those exist. Here's why they're useful. And here's how we come up with, you know, payments and things like that. Cool. Awesome. Yeah, thank you.